This is Mike Scarell for another financial portal. The commercial mortgage-backed securities market continues to struggle as more deals go into special servicing, default, and liquidation. We spoke with Realpoint Managing Director Frank Innaurato about some market trends.
Well, contrary to optimistic expectations for other commercial real estate market statistics, we are continuing to see an increase in delinquency on a monthly basis within our CMBS database. Just through June alone, CMBS delinquency increased to over $60 billion from roughly $57 billion a month prior. We're continuing to see a rapid movement of loans that are being transferred to special servicing with requests for debt relief and fear of imminent default. This is also having an obvious impact on the rapid growth of loans in special servicing overall. The delinquency rate for CMBS through June had grown to over 7.7%, and our expectations and projections have delinquency growing potentially anywhere between 10 to 12% under heavily stressed scenarios through year-end 2010.
What's moving the markets? What's the big story?
Well, while we are tracking some very large, what we like to identify as high-risk loans within the CMBS database, these are loans that have exhibited heightened levels of credit risk. The transactions issued from 2005 through 2007 are highly concentrated in large loans with substantial unpaid balances where cash flow has not met underwritten expectations or has declined substantially due to other market conditions and the like. There are many properties that are found on the Realpoint watch list that are considered high-risk loans with increased default risk that are a large portion of what is driving our delinquency percentage. Just to give an example, outside of the extended stay hotel loan, which is currently delinquent, and the Peter Cooper Village loan as well, very sizable loans that for a long period of time were current but specially serviced and later became delinquent. We are also tracking a large portfolio called the Beacon in Seattle portfolio, which is roughly $2.6 billion of debt across 6 pari passu notes. The loans remain current in payments, but the borrower has already given indication through written correspondence that he's unwilling to commit additional capital, and if that loan were to go delinquent in and of itself, you're looking at an additional $2.6 billion of debt that's specially serviced being transitioned into the delinquency category. Other drivers include hotel assets that continue to struggle across the market, some retail properties that have been unable to re-tenant dark space or inline space that has gone dark as a result of losing in anchors. Not much to report on the office side, but overall, Realpoint's watch lists continue to remain flat or grow based on updated financials that have been reported for year-end 2009 and year-to-date in 2010.
When does the delinquency trend begin to flatten and potentially reverse? If you're looking into the crystal ball, when?
Yeah, looking into the crystal ball, it's hard to predict when delinquencies will end. Hopes were that we might bottom out at some point in 2010. Most of our experts and our expectations is that we may not truly hit a bottom of the market until some point in 2011 as commercial real estate continues to lag the economy. We have not yet seen a slowdown in the transfer of loans to special servicing or the rate at which new loans are being reported as delinquent. Thus, we're still trending upward by both dollar amount and percentage of delinquent assets. While new issuance has picked up, it has not picked up to a point that can correspondingly offset the rate at which new loans are being reported as delinquent. Crystal ball, looking a little forward, we're most likely looking at some point in 2011 before we really start to see any positive signs by way of delinquency slowing down. Most property market experts and optimists will hope and have been forecasting that as some statistics have shown flattening by way of, say, vacancy rates across the country, asking rents in certain properties. It's very obviously market-specific and property-type specific. While much of that data is being reported on a monthly basis living within the CMBS, in and of itself, we continue to see borrowers and properties struggle. So while at a higher level, some of the more global statistics are showing signs of improvement, I think we have some time to go before things stabilize within the legacy CMBS market, and that is why we continue to see delinquency grow. In some cases, and in many workout scenarios, extensions will continue to be the norm. Loan modifications will delay the true workout of assets, and yet liquidations continue to grow by substantial numbers, especially over the last 6 months or 3 to 6 months of 2010.